My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you a little money. My job is to entertain, to educate, teach. Call me 1-800-743-CNBC. Tweet me at Jim Cramer. All right, I got some tough news for everyone who's sick of a market that's led by just a handful of tech stocks. You're wrong. Look at the stock of Eli Lilly, which was up nicely today on the news of an acquisition. They're buying a biotech company for $3.2 billion to expand into the inflammatory bowel disease space, gigantic space. On a day when the Dow dipped 31 points, S&P advanced 0.1%, NASDAQ gained 0.28%, I think it's worth pointing out that there's no rule that says only the tech titans can lead us higher. Sure, Apple and Amazon and Alphabet and Meta and Microsoft and NVIDIA, yeah, same old, are on the move. And yes, we can say it's ridiculous that they keep climbing, and some people can cling to the idea that they're overvalued. But I say, wait a second, cowboy. Where does it say that this club is restricted? Where does it say that nobody can join in except companies that are loaded with tech, especially generative AI? Perhaps we should stop wasting our time worrying about how the gains are concentrated in the hands of a few cloistered tech titans, and instead think about how a company can become sane simply by doing everything right. Where are those companies? Why aren't there more of those companies? Again, there's no rule that a pharma stock can't lead this market, just like there ain't no rule that says a dog can't play basketball. Which brings me back to Eli Lilly, the Air Bud of Big Pharma. Think about what Lilly's accomplished here and how it's knocking on the $1 trillion door with a market cap of $872 billion. By the way, at one point it was close to $900 billion before the stock pulled back from its highs. First, Lilly comes up with a weight loss and diabetes control injection that competes directly with Novo Nordisk's Ozempic. But unlike Novo Nordisk, Lilly has a huge balance sheet and can afford to put up gigantic, complicated, multi-billion-dollar plants to pump out their drug. That matters because production capacity will be the real gating factor against the competition. It's why we did not take profits in Lilly for the charitable trust when we heard of all the competitors at the JP Morgan Healthcare Conference in San Francisco at the beginning of the year. Credible competitors. I'm talking about Regeneron and Amgen. And boy, we didn't jump ship when Viking Therapeutics burst on the scene with a positive clinical trial for their own GLP-1 drug. How the heck can Viking make enough of it to matter? I'd only worry about this one if Big Pharma now, let's say Pfizer, which failed its own weight loss drug trial, swoops in and buys Viking. Lilly's drug is just too good. And while we know it works on sleep apnea, weight loss, and diabetes, you know what? I think the biggest indications involving heart problems, including blood pressure, are yet to come. Right, that's not all Lilly's doing. Right now, it's gotten approval for a drug that slows the progression of Alzheimer's disease, long considered totally impossible to take on. Kazluna is safe, and for many people, it works to hold back the disease. And this is according to my own sources in the brain and migraine community. We don't know the size of this market. We just know, sadly, it's growing like a weed, and this drug is one of two hopes, the other being from Biogen. And now Lilly takes the cash that's spewing from its coffers and buys Morphic, a small early-stage biotech for $3.2 billion, fulfilling a promise to find new drugs to build its pipeline. Sure, that's a 79% premium. I know that seems like a lot, but Lilly needs to focus on the burgeoning immunology segment with a pill to help manage inflammatory bowel disease, ulcerative colitis, and Crohn's disease. These are large and growing diseases, some of the fastest out there, sadly. While Lilly has done what Lilly's done with its money is get behind a drug that might be more potent than its own competing drug candidates that are listed on its website. It's worked diligently to ensure that it has no real patent cliff, unlike, say, Pfizer, which is in a deep one, or Bristol Myers, which is similarly suffering. Oh, and let's not forget, every time you hear that so-and-so might have a pill version of some GLP-1 weight loss drug competitor, not just an injectable, remember that Lilly's working on a pill, too. Why is Lilly's strength so important to me and should be to you? Simple, because it's an obvious winner outside of big tech. Rather than bemoaning the limited breadth of the market, maybe we should be asking why other companies aren't joining the club. Who's to say that only pure technology can win here? If you actually show smarts as a CEO, if you have a vision, if you can execute well, then you can belong in the mega cap universe too. There is no law that says you can't. This week, for example, we get earnings from JP Morgan, arguably the best bank in the world. Its market cap is not insignificant, $589 billion. The stock trades, though, at a ridiculously low 12 times earnings multiple. Why shouldn't it sell 22 times forward earnings instead? That's what people are paying for the average stock in the S&P 500. Is JP Morgan, the best bank in the world, actually worth dramatically less than the average stock? PepsiCo also reports this week. In 1995, Coca-Cola was the second biggest company in the Fortune 500. Now PepsiCo has double the revenues of Coca-Cola. Hey, maybe if it made more swift moves or bigger takeovers, then it could be worth $1 trillion instead of $223 billion. A shrewd observer recently asked me by email, how could Exxon, with $330 billion in revenues over the last 12 months, not be much bigger than NVIDIA, which rang up just $79 billion in revenues in the same period? Well, Exxon's worth $500 billion, while NVIDIA clocks in at $3 trillion. Well, the answer to that is that this market values growth much more than it just values plain old revenues. And I got to tell you, NVIDIA's got the growth in spades and much higher margins. Oh, and Ford, which I actually think is breaking out, had $177 billion in revenues, while Tesla, considered by many to be a tech stock, not an auto stock, had $95 billion in sales, both in the last 12 months. But Tesla's worth $800 billion, and Ford's valued at $51 billion. If Ford can come up with an electric car that outsells Tesla and makes more money per vehicle and then replicates that in Germany and China, well, guess what? I think Ford could be a mega cap, too. There's no restriction on that. All these material differences, the stepping stones to $1 trillion, have been scaled by companies that simply can't stop innovating. Amazon comes up with Amazon Web Services and Amazon Advertising. Meta dreams up Reels take on TikTok. Apple's got a monster installed base, which allows it to get the artificial intelligence technology from other companies for free, simply because they want access to all of Apple's customers. Microsoft has Copilot and ChatGPT. Alphabet has the staggeringly popular YouTube. NVIDIA now has a whole platform to go with its chips, including software. These companies maintain their status through invention. The question is not why they're so sainted while others get left behind. That's obvious. The question is why other companies aren't doing the same thing, say, that Eli Lilly's doing to get in the winner's circle. Or, hey, like NVIDIA, the company that came out of nowhere, but not really. CEO Jensen Huang was working on the concept of these ultra-fast GPUs a decade ago. I think there's so many companies with failures of imagination that they are their own worst enemies. The winners here are colossal thinkers. Much of the S&P would do well to show some similarities to the tech titans. Bottom line, it's time to stop castigating a market that awards trillion-dollar status to a scant few and start recognizing that companies only reach those heights because they've earned it, and others would be very good to emulate them. Rhonda in Kansas. Rhonda.
Booyah, Jim.
Booyah, Rhonda. What's going on?
Jim, Spirit Aerosystems, a Boeing supplier. Your perspective, please.
Okay. Now, Boeing's buying them with stock. I think that there's a persistent buyer of Boeing in this stock market every single day. And my take is actually, I know this is going to be a little counterintuitive, keep it, buy it. Spirit is going higher, I think. Boeing has to buy it. And Boeing saw the worst possible thing happen today, and it's still flying. Eddie in Texas. Eddie.
Good evening, Jim. Given Pfizer's recent performance, heading into Q2 earnings, is Pfizer a buy?
All right, this is one of the toughest questions possible. And the reason why it's so tough is we must see something from CGen, the old Seattle Genetics, this quarter. If not, the stock's going to go to a 6.5% yield and go lower. So this is a make or break quarter, and we're all going to wait for it. I need to go to Tom in my home state of New Jersey. Tom.
Mr. Cramer,
yes.
Great to talk to you. Listen to you every night.
Thank you.
Just want to say thank you for all the work you do for all the little guys. And I just wanted to ask you about Disney. I've had it a couple of years, and it just doesn't seem to be going anywhere.
No, it doesn't. No, Tom, please don't do that. My charitable trust has been buying some right here. It sells at only 20 times earnings. It's got box office success. It's got the theme parks. I want to thank you for the kind words, but I'm urging you not to sell Disney. And if anything, I would be inclined to buy some. Right? Companies only reach the $1 trillion status when they've actually earned it. The question is not why they're so sainted while others get left behind. It's why other companies aren't doing things to get them in the winner's circle. Failure of imagination, people. On Man Money tonight, many say the market knows all. So are stock prices offering clues as to what we'll see in November's presidential election? I'm going off the charts to find out. Then, is the tap running out for Constellation Brands? Am I eyeing the company after earnings and giving my key takeaways from the quarter? Plus, I'm giving my take on whether Nike can find its footing in an uncertain market, as promised this morning on Squawk on the Street. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Now this market's experienced a remarkable run during the first half of the year, and we're getting into the period where the presidential election dominates the airwaves, can the averages keep running? Now, going back to 1928, the S&P 500 has rallied 75% of the time in election years. That's 3 out of 4. But the average gain is only 7.5%. Now, this makes things tricky because the S&P is currently up more than 16% year to date. And we're doing one of the most candidly insane elections I've ever seen. High-ranking members of the incumbent's party keep urging him to drop out of the race after that horrifying debate performance. Meanwhile, the challenger is now a convicted felon, although the sentencing is likely to be a slap on the wrist. Looking at the polling, it's hard to imagine Biden getting reelected, but for all we know, Biden might not even be the Democratic candidate. Maybe we get a contested Democratic convention like Chicago in 1968, in which case I hope we get another Pegasus the Immortal. The domesticated pig nominated by the Youth Industrial Party, International Party, I'm sorry to get that right, only presidential candidate to have been confiscated and possibly barbecued by local law enforcement. Now, I bring this up because there are major differences between the two parties on economic policy. Those differences will affect vast swaths of the stock market, right? So is there any way we can divine the election results from the action in the market? We all know the market's basically a prediction machine, and it tends to be pretty darn accurate, which is why we need to know what it's saying. And that's why we're going off the charts with the help of Larry Williams, legendary technician, market historian, been the best in the business since I was a teenager. He's written over a dozen books and created a ton of proprietary indicators we use all the time. Larry's also made some stunning calls for us in the last few years. He nailed the COVID bottom. He nailed the market-wide bottom late last October. He nailed the pullback in the high-flying tech stocks this spring, and the fact that the pullback would come to an end in May. Boom. So what does Williams have to say about the state of the election year stock market? Okay, first, take a look at the action. This is the Dow Jones Industrial Average. This is going back to late last year. The red line shows the Dow's average performance in years where the president was not reelected, okay? Gerald Ford losing to Jimmy Carter. Carter losing to Reagan. George H.W. Bush losing to Clinton, and Trump losing to Biden 4 years ago. You could say that this incumbent losses average match the Dow's performance pretty well so far. But Williams says you probably shouldn't read too much going into this picture. See, going back to the 50s, we've had only 4 election years where the incumbents lost. Tiny sample size. Just not enough to draw much of a conclusion from how. But about the election years where the incumbent won. Okay, so let's get this. Now, here we go. Okay, check out the performance of the Dow Jones Industrial Average paired with how the Dow did on average during years when the president got reelected. Again, the pattern seems to fit the action pretty well until mid-May, where the connection falls apart. Okay. Although this one has a larger sample size, it's not so much larger in caution. Williams actually cautions you, again, not to take this chart too seriously. However, one thing to note is that the fact that the Dow historically tends to perform pretty well going into August during years when the incumbent wins. Let's think about that. That's why Larry prefers to look at how the market's held up during the averages of all election years, where we have lots of data, regardless of who wins. So here we go. So this time, check out the performance of the Dow paired with the average performance in every election year since 1968. When the aggregate of all the election data, when you aggregate it, you can see that the Dow tends to soar starting in the first week of August, before pulling back over the course of October until the last week where the market starts rallying again into Election Day. Then after Election Day, stocks tend to keep running. So in nearly the last 60 years, Williams sees 2 patterns. First, stocks typically do well in August, which is highly unusual. That's a dreadful month. Outside of election years, August can be really terrible. Second, stocks tend to get hit over the course of October before bottoming roughly a week or 2 ahead of the election, at which point they typically go back into rally mode. So we've got buy opportunity, and then, of course, buy opportunity, but that's already occurred. Again, regardless of who's winning or losing, don't forget, the stock market craves certainty. And except in some rare situations like 2000, when we had to wait on the Supreme Court, Election Day gives us certainty. As Williams sees it, these are the two most reliable election year patterns. Let me give you the bottom line. Can the market tell us who's going to win in November? Elections happen so infrequently in this country that the historical patterns don't give us much of a guide to predicting the outcome, especially in an insane year like this one where we're still not entirely sure who the candidates will be. But the charts, as interpreted by Larry Williams, suggest that the Dow almost always rallies in August. What a takeaway of any given election year. Remember, historically bad month, regardless of who's ahead. And that's exactly the kind of pattern that you can make some money with. Mad Money's back after the break.
Coming up, with summer in full swing, who feels like a drink? Grab a glass and join Cramer for a look at Constellation Brands. Next.
Sometimes the misconceptions in this business are just too great to overcome. And you got to ask yourself if the market can stay wrong longer than you can stay solvent. Take Constellation Brands, STZ. On Wednesday, the company reported almost stellar numbers, and yet the stock still plunged, dragged down by deep-seated misconceptions that can't seem to be put to bed. Constellation is a strange amalgam of Mexican imported beers and fairly high wine and spirits. It's by far the best performer, not of beer, but of all consumer packaged goods companies. That's right, all of them. It's the beer, Modelo, Corona, and Pacifico that's driving things here, with an 8% increase in sales. Remarkable. Modelo is the number one brand in the United States, continues to gain share. Modelo Especial grew 11%. Hey, get this one. Pacifico, you're the long necks, up 21%, while beer sales were roughly in line. Constellation's operating margin expanded by an astonishing 260 basis points. Wine and spirits declined 7%, but that's tiny compared to the beer business. At this pace, by the way, wine and spirits will be less than 10% of sales. Compared to beer, it's not really even enough to move the needle. In theory, Constellation's growth is so much better than any major carbonated beverage or packaged food business. You could argue that the stock should sell at $300 easy instead of the current $253 price target, but it doesn't. Why? Simple. Constellation sells alcohol, and Wall Street has given up on alcohol, even if the consumer hasn't. So despite the company's tremendous 70% earnings growth, the stock couldn't get any traction when it reported. It was one of the worst performers that day. It has recovered somewhat on Friday, but it got rocked again today, though, down $5.30 or 2%. I like to think our small trim of Constellation position for the charitable trust last week, built up during a recent weakness, didn't play a role in the decline, but I'm a realist. I know sometimes that can happen. Instead, what mattered, though, is that I think Wall Street turned on alcohol in a way that makes really the great work of CEO Bill Newlands irrelevant. Now, it's true that Constellation stock is running circles around the rest of the industry. It's up 5% year to date, while Bud's down 8%. Boston Beer's off 15%. Molson Coors has lost 18%. The weakest part of Constellation's wine and spirits isn't crushing the stock, unlike Diageo, off 12%. And the incredibly poor performer that is Brown-Forman, which has fallen 26%, thanks to weakness in the once invincible Jack Daniel's franchise. In some ways, the relative strength of Constellation is even more impressive than it seems. The analysts of the call seemingly wanted to be positive, but were concerned about a potential Trump win. Now that he's floated a 10% tariff on all imports, including beer, they were concerned about how the beer brands were, quote, starved, according to Bonnie Herzog, a very good analyst from Goldman Sachs, a proposition that was handily refuted by Newlands on the call. And there was a question about beer, quote, sentiment, end quote. How it's going out of style on the Wall Street fashion show. Just look at the declines in Molson Coors for Bud or Boston Beer. Never mind the Constellation stock is up. It's in part because it keeps introducing winning new products like this Corona Sun Brew, which is a non-alcoholic potential blockbuster. Now, Newlands kept coming back to the fact that the brands are beloved with incredible customer loyalty, and that is so tough to refute. So why isn't the stock higher, though? How can a company that's generating huge free cash flow and is actually expanding with a greenfield brewery in Veracruz, spiking capital expenditures to $3 billion, and yet still has enough money to buy back $200 million worth of shares? Not to be the king of consumer packaged goods. This should be the king, and I'm going to give you 3 reasons why it isn't. And I think that when you think about them, I think you really understand what's going on. And the first, of course, is the GLP-1 weight loss drugs, led by Lilly and Novo Nordisk. They are said to be reducing alcohol sales. Now, widespread belief, even though nobody in the business Nobody in this brewing business, no one in the booze business will admit to this. Wall Street thinks it's just a matter of time because people who take the GLP-1s absolutely do not crave alcohol as much as they did before. There have been no studies about this, but the medical profession is well aware that these drugs turn heavy drinkers into light drinkers. And Wall Street assumes it's these drugs will clobber both beer and its wine and spirits portfolio. Second, while beer is more linked to experiences than the desire to get hammered, there is a strong belief on Wall Street that the younger generation, particularly between 21 and 26, has sworn off anything that's bad for their health and wellness. My generation grew up believing that light drinking is a benevolent vice and that wine is actually good for you in moderation. But the medical world has long since discredited anything positive about alcohol, which is literally a poison. Finally, most devastating is the increased prevalence of cannabis with its easy, inexpensive, high, without a hangover. You know what you're getting here? You're getting buzz without a hangover. And that is the holy grail of recreation, they tell me. Yet the alcohol industry is in total denial about the competition from legalized weed, even as Constellation owns a big stake in Canopy Growth, the most visible cannabis company. As regulations on cannabis loosen nationally, beer sales go down, except for Constellation's. Again, in part because of the loyalty of the fast-growing Hispanic community mentioned multiple times in the conference call. None of this is helped by the endless selling of the Sands family, a hidden detriment to its stock that just won't stop, maybe until the buyback expands, which Constellation can't do without jeopardizing its credit rating. There used to be two classes of stock here, the presiding one of the Sands family and the common stock owned by mere mortals. The company spent $1.5 billion in 2022 to eliminate the Class B shares, money that made the company independent and maybe even a possible takeover target. But then the Biden administration's strident antitrust policy basically eliminated any hope of Constellation being acquired. Against that, the activists at Elliott Partners agitated for a board seat and a plan to improve performance in 2023. Now, get this. It was one that was welcomed by Newland. Smart man. Smart move. It was as smart as Constellation's 2018 decision to invest. Well, no. I don't want to be too mean. As smart as that was, the decision to invest $4 billion in cannabis maker Canopy Growth, that was stupid. And that's led to hefty write-offs as the market never materialized. It's a testament to Constellation's strength that it could absorb such losses with aplomb. Just like when it spent $1 billion buying Ballast Point in 2015, only to sell for a mere $41 million just 4 years later. I mean, man, this is the classic buy high, sell low company. Newlands was not responsible for either disaster, but he's had to deal with the consequences, which are finally almost behind them. Which brings me to back to the beleaguered state of the stock. If you want to be a great investor, you can't afford to be worn down by shadow boxing against the bears. But when the bears have GLP-1, health and wellness, and cannabis behind them, well, it's almost become too much to resist. Now, capital expenditures will peak this year as the Veracruz Brewery spending tops out, very positive. This will lead to a more aggressive buyback, again, very positive, perhaps even enough to absorb the selling from the Sands family. However, the simple truth of how a stock can go down hard on tremendous earnings, albeit inline sales, and no forecast increase, just became too much for me as a money manager. No, we're not abandoning the stock for the charitable trust. It's too valuable, and there's always the chance that people realize the greatness of this business, as we told members of the CNBC Investing Club. But the bottom line, Constellation's compelling lesson that you could have the premier factual growth story be defeated by the premier challenge to weight gain, without weight gain ever really being discussed in the conference call. The elephant in the brewery, hidden in plain sight. Susan in California. Susan!
Hey, Jim. Hey, two things. Want to let you know I love your teaching, and I've got my daughter and my grandson into stocks. Thank you very much.
Yes, that's what I want. That's how you can get wealthy in this country. I mean that.
Agree. And that's helped me. I am just into Chipotle, which you have been in love with for years.
Of course,
we know it's split. What do you see its direction going for the next year, stock-wise?
So let me tell you, Susan, it's a great question. I had said that when they did this magnificent, gigantic split, there would be a lot of selling coming from people who say, you know what, I have too much Chipotle. They did a very effective split. It's got the stock down to 59. We are still working off that split. I will make no decisions about this stock until I sense that the churn is over, and the churn is not over. Now we're going to go to Arthur in New York. Arthur.
Booyah! Jim Cramer from Poughkeepsie, New York.
Oh, how you doing? That's where my in-laws are from.
Oh, you're kidding me.
I love it up there. I love it up there.
No, Hudson Valley is beautiful. Now, my question is to do with Amazon and its long-term prospects, considering that years ago many of the conglomerates had to divest of a lot of different businesses and unable to be profitable carrying all these businesses. What do you think?
Arthur, I've got to tell you, I'm not going to disagree that under even more aggressive FTC and Justice Department, that Amazon would have to break up. If it did break up, these businesses are worth so much money that I still would hold the stock for my charitable trust, and it's been a major position of mine for about a decade. I'm sticking with it. Thank you for the call. Okay, we aren't abandoning STZ, Constellation Brands, for the charitable trust. We just did a little what I call a schnitzel. I'm banking on a chance that people will still realize the greatness of this business, but boy, it's been tough, huh? And much more Mad Money. I'm taking another earnings deep dive into Nike, as I promised you this morning on Squawk on the Street. The stock has been swooning after cutting its full-year guidance, but could it lace up a turnaround? How do you like my puns? I'm giving my take. Then, the pressure is on for Powell ahead of this sit-down with the Senate and the House this week. But could he hold a winning hand? I got a message for the doubters. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So, stay with Cramer. Oh, boy, is there any hope for Nike? Can this formerly unassailable sneaker company finally turn things around? Or is it time just to throw in the darn towel? Back on June 27th, the company reported a truly dismal quarter, and the stock lost 20% of its value the next day. Some would call it a haircut. I call it a beheading. The stock's now at the lowest level since March of 2020. Hey, that was COVID, man. And that still hasn't been enough to attract value hunters. I mean, just today, the stock, it fell another 3%, finding new lows. Sell. I mean, it is incredible. Hence the question, can Nike still be saved? Is there any real hope here? Look, if there is, I think the stock's a good buy down at 73. But it does seem like a hopeless situation. And then we have to admit, if that's true, that Nike's a value trap. Even if it has already fallen 59% from its highs in late 2021. This is Nike, one of the great senior growth stocks of all time. So which is it? First, we need to figure out what's going on here. When Nike reported a week and a half ago, the actual quarterly results were fine. Not great, not even good, but fine. Their sales came in weaker than expected, down 2% year over year, with key regions like North America, Europe, Middle East, and Africa struggling to grow. Even though everybody loves to worry about Nike's Chinese business, Greater China was actually their only region with higher than anticipated sales. Even though the company's sales were not so hot, Nike's profitability was terrific, with the company reporting a 17-cent earnings beat off an 84-cent basis. Do you know that this stock looked like it was going to trade up when this first happened? They had 53% adjusted earnings per share growth, for heaven's sake, although nearly all of that came from cost cuts, including the 2% headcount reduction they announced in February. In the end, it was a mixed quarter for Nike, something that could explain a small sell-off, but definitely not the 20% tumble we saw the next day.
The House of Pain.
The real problem? Okay, so management gave us a grim full-year forecast, talking about mid-single-digit sales shrinkage when the analysts were looking for 1% uptick. Even worse for the current quarter, Nike predicted a sickening 10% decline in sales, far worse than the 3% hit that Wall Street was expecting. At the same time, management doesn't think they'll have enough cost cuts to bail them out on the earnings front, especially not with everything that they're investing in the upcoming Olympics, brought to you by, NBC Universal. Long story short, the big news here was that Nike's return to sales growth is going to take a lot longer than the bulls had hoped. CEO John Donahoe even said the 2025 fiscal year, the one that just got started, would be, and I'm going to quote him, a transition year, which is a phrase that no shareholder ever wants to hear, especially from a company that's already coming off 12 months of flat sales. Transitioning to what? Explaining the door outlook, CFO Matthew Friend cited a laundry list of headwinds. Boy, was he downbeat. Continued weakness for classic footwear franchises, including Converse, which has been doing terribly, down 18% last quarter. Lower growth for Nike Digital, increased macroeconomic uncertainty, especially in Greater China, and the generally uneven, that's his word, consumer trends, especially in the Europe, Middle East, and Africa. The biggest disappointment? So many of Nike's former strengths seem to have turned into weaknesses. Their company's lifestyle business, wow, this has been growing at a double-digit clip for the past several years, declined last quarter with widespread weakness. Even the once unassailable Jordan brand was down. It's also tough to see how Nike Digital, previously one of the company's top growth drivers, doing so poorly, down 10%. So they don't see it improving anytime soon. And then there's China, which was a key source of growth for years. China's post-COVID recovery was a key leg for every bull case for the stock. Now, though, that leg has been injured, even as the numbers, as I mentioned, did surprise to the very low bar upside. The morning after its earnings report, something astonishing happened for this incredible growth stock. Nike got hit with 6 separate downgrades. Sell. All of which took the stock from buy to hold because the company indicated the turnaround will take longer than planned. Many on Wall Street now are wondering if CEO John Donahoe is he the right man? Is he the right man for the job? I mean, Donahoe's a tech veteran who previously ran ServiceNow and eBay, did a great job. For taking over at Nike in January 2020, is that a strong enough sports background to be Nike's CEO? I like the guy personally, but he was brought in to get tech right, like the direct-to-consumer initiatives that now seem to be faltering. Which brings us back to the key question. Is there any hope for Nike going forward? Let's start with this. If you're betting on Nike here, you're betting that the latest quarter was what we call a kitchen sink quarter, meaning a quarter where management rips the Band-Aid off and gives investors all of the bad news at once. They throw everything at you but the kitchen sink. Given the long list of issues cited by management, that wouldn't surprise me. Maybe Nike's gotten tired of leaking underperformance drip by drip by drip by drip by drip, and finally decided to just assume the worst when it's coming up with the guidance. If this was a kitchen sink quarter, then the sell could be, yes, indeed, a buying opportunity. Buy. Because it means the estimates are low and Nike may be able to surprise to the upside. Remember, management's projecting sales down 10% this quarter and down mid-single digits for the full fiscal year. And those are incredibly low bars. I'll also say this. Nike stock now sells for less than 23 times forward earnings estimates. Even when the economy shut down in March of 2020, it was only traded at 25 times estimates. Cheapest the stock has been since 2017. Of course, the valuation argument only matters if Nike's capable of at least meeting its own estimates. While Nike's missed sales estimates in 3 of its past 4 quarters, it's beaten the earnings estimates for 15 of the last 16 quarters, often by a wide margin. There's good reason to feel confidence in the earnings here, even on this struggling sales front. Frankly, I've been down on Nike, as you know, for a very long time now. I have been worried about powerful competition, particularly from Hoka, and On is one I've been recommending for ages. But now that everyone else hates Nike so much, the expectations have gotten so low, I think you should never underestimate the power of low expectations. Still, I feel a lot better about turning positive on Nike right here, right now. If we had more of a turnaround plan from management, how about some credible blueprint going forward? Right now, the company seems focused on making things less bad by reducing supply into the marketplace, launching fewer new products. That's just not exciting. It's not a hook. So I want to hear a credible plan from management about how it can get its business growing again. If they can't or won't give us that, then we need new management. However, that 20% post-earnings sell-off feels more like a good buying opportunity than a reason to turn negative on the stock. To the 6 analysts who only downgraded it after that hideous guidance, all I can say is, what took you so long? Frankly, even without a well-educated turnaround plan, without a well-articulated, without anything dazzling me, I think the stock can work simply if things turn out to be less terrible than management projected. Maybe the Olympics is a positive catalyst. 3 quarters ago, it seemed like that was all they were talking about. Maybe China turns. Maybe back-to-school season's solid and the consumer in the U.S. and Europe stronger than people realize. Maybe none of that happens, so Nike changes its CEO and the market decides that's a positive development. A lot of good things could happen here. So, the bottom line, I know things look bleak for Nike right now, but the expectations have finally gotten low enough that I think the risk reward is skewed to the upside here. Yes, that's right. Down here, after still one more hammering, today, I'd rather be a buyer than a seller. Mad Money's back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
It is time. It's up to the lightning round. That's right. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. I'm going to start with, how about Mandy in California? Mandy.
Yes, Jim, that's me. I am a first-time caller and also an Investing Club member.
Excellent.
So, first of all, thank you for the vast amount of information, wisdom, and experience that you have been sharing with us.
You're very kind. Thank you.
So, Jim, I thought that a good opportunity for me to buy, to be indirectly involved in private equity investing is to buy a stock like KKR.
I couldn't agree with you more. KKR is the foremost. The other one I would recommend is Blackstone. Those are the two I feel most comfortable recommending. And beyond that, I don't really feel comfortable because I trust these people and know what they're up to. I need to go to Ned in Ohio. Ned.
Hello, Professor Cramer, CEO
How are you, Ned?
of Primerica. How are you today?
I am doing very well. Back from vacation, strong and excited. How can I help you?
Well, sir, I wanted to talk to you. I looked at the 5 top steel producers in the United States, starting with Nucor and including Cleveland Cliffs and U.S. Steel and 2 others. And I noticed that they've underperformed, and several of them have lost 30 to 40% of their value in the last 3 or 4 months. So with the infrastructure spending catalyst that's supposedly out there, 45,000 bridges in poor repair, and ports, airports, railroads, automobiles, steel should be in demand.
It should be, but the fact is, Ned, the problem is that the price for different grades of steel is falling. And that's why a Nucor can't seem to find any fitting, or a Letter X can't find any fitting, or you mentioned Cleveland Cliffs, and that's the one I want to focus on for a second. That's the one that has the most spring. That could be just a coiled spring down here. However, understand that the price of the commodity, when it falls, people do not buy any steel stocks. Now I need to go to Mark in Washington. Mark.
Yeah, hey, I'm calling you from beautiful Ocean Shores, Washington. Curious about Hertz, HTZ.
Well, I think that you live in a beautiful area, and I don't want you to own that stock and then not look out the window and think about that stock instead of the beautiful area. Let's go to Carl in California. Carl.
Hey, I'm worried about a company. I see a lot of what they sell available on Amazon for less. What do you think about Ferguson?
Boy, I tell you, I see Ferguson stuff everywhere. I think Ferguson's a very, very good company, but if you want HVAC, I mean, people are saying, look, then you got to own Train. The Train is probably unbelievable right here, or you have to own Carrier, and people don't want to own Ferguson. Those are the 2 that I'll recommend, and they're really, really well run. Dave Gitlin at Carrier is extraordinary, by the way. Let's go to Jason in New York. Jason.
Hey, Jim, first-time caller, long-time viewer. Jim, you're the Energizer Bunny of finance.
Thank you. How can we make money together?
Okay, I'm interested in an oil stock. I want to buy Petrobras. Is that a good investment?
Well, I'll tell you, there's a great place called the River Grill. It's near me, and they have PBR on tap. And I'm willing to pay any amount for that PBR, but I will pay no amount for PBR, Petrolio, Best, or PBR. No, so the answer was not buying that one. Let's go to, hey, nice shout out, by the way, to River Grill. Hear him with that? He has never gotten a free one either. How about Dave in Massachusetts? Dave.
Hi, Jim. How are you tonight?
Oh, I'm great. Thank you for asking. How are you doing?
I'm doing well, thank you. And thanks for all that you do and for taking my call.
Thank you.
I was calling, you're welcome. I was calling to get your thoughts on ARLP in general.
Well, it's had a very big run, okay? And I've got to tell you, it is coal-based. I know the yield looks great. I think you're peaking on a coal cycle here. I am not going to get in front of a peak of a coal cycle. Let's go to Bill in Massachusetts. Bill.
A big Boston booyah for you, Jimmy Jams.
Well, I'm trying to figure out whether to buy the Celtics. You know, I kind of talked about it in the office. We think about we're going to cash in our considerable stake in the Eagles, which is represented by my season tickets, and buy the Celtics. What's going on? Bill? I went on too long about the Celtics. What can I say? But I thought that Scott Wapner had a darn good show today. Well, let's have come on, let's go one more. Let's go to Jerry in Missouri, please, Jerry.
Hey, Jim, welcome. Taking my call.
Oh, of course. What's going on?
Jim, recently you suggested that one of the world's cheapest stocks was Chinese. Do you still like it, and do you see any catalysts that will cause Alibaba to rally?
Right, Alibaba is the cheapest stock in the world, I believe, on growth and also on its breakdown value. Dave Tepper, one of the greatest investors I know, believes this too. I think you just have to hold it right here. I'm not being aggressive, but you have to hold it. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, is Jay Powell close to achieving the unthinkable? Why the Fed chief is well equipped for a stroll down Capitol Hill. Stick with Cramer.
Jay Powell may have a winning hand after all. The Federal Reserve chief is on the firing line tomorrow when he goes in front of a Senate panel, and then on Wednesday when he heads to the House. And I think he's in good shape, even if our elected leaders disagree. Remember, this is a man who raised the Fed funds rate 11 times, many of those double or triple rate hikes, taking the key rate from near zero to its current range of between 5.25 and 5.5. It's the highest level in nearly 20 years. Now, usually that'd be terrible for the economy, right? But we have seen a number of bankruptcies or dramatic layoffs or a massive spike in bad loans. No. How about none of it? Instead, we've got generous number of jobs that still need to be filled. Last Friday, non-farm payrolls increased by 206,000 positions. Average hourly earnings moved up 0.3% for the previous month and up 3.9% from a year ago. Workers are still getting raises, but at slower paces. Where's all this bankruptcy? At the same time, the unemployment rate climbed to 4.1%, which may give the Fed actual cover to start cutting rates as soon as September. Especially because last month's uptick in employment came mostly from government and healthcare, which accounted for 70,000 and 49,000 jobs respectively. Social assistance contributed 34,000. These are not economically sensitive areas, people. There's nothing that they can do about the government jobs. No amount of rate hikes will put much of a dent in healthcare spending either. So if we have a tame consumer price index number on Thursday, it seems like a good bet that Powell can talk about having room to cut rates. Although that might be too far for him to speculate about the CPI during his testimony. Too early. If Powell can pull this one off, though, he may do the unthinkable, giving us the fabled, some would say mythical, soft landing. If you go back to when the tightening cycle started in 2022, there were so many doubters for every part of Powell's agenda. The soaring inflation, especially wage inflation, not to mention the supply chain problems courtesy of COVID. I usually try not to spend too much time talking about the Fed. Yes, wasting time about the Fed, although often it's unavoidable. I prefer to talk about stocks, and I want to point out that millions and millions of people have been hiding in high-yielding cash, avoiding a stock market that could have made them fortunes if only they hadn't been scared away from the asset class by all the predictions of an inevitable hard landing. Nearly all the experts argued that a soft landing was impossible. They thought Powell would need to absolutely wreck the economy in order to contain inflation. They frightened everyone. Looks like they were wrong. So I want to call out all those people who endlessly doubted Powell. They doubted him when COVID struck, and he took rates down quickly to avoid what could have been a severe recession. Sure, he misjudged the risk of inflation, but when he realized his mistake, he went in hard to take rates up again. The only actual mistake he actually made was dealing with rampant housing inflation, with the median U.S. home price up almost 30% since the end of 2019. That's too high. The rate hikes raised the mortgage rates, but they didn't stop the buyers because so many had so much cash. At the same time, higher rates made the housing shortage worse because existing homeowners don't want to sell their properties to buy new ones, as that would mean trading ultra-low-rate mortgages for high-rate mortgages. Meanwhile, the homebuilders don't want to put up new homes when they see mortgage rates going higher because they worry about being stuck with excess inventory. But housing is a real no-win situation for the Fed. Still, if that's the sole defeat for the Fed in a tumultuous period, knowing that if a different president gets elected, Powell will most likely not be kept, I say we salute this man. Yes, he may finally have a winning hand, but then again, he created that hand. I like to say there's always bull market somewhere. I promise to fight just for you right here, man. Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.